Let's talk real estate and housing with Aaron Jodka joining us from Collier's Director of Research covering U.S. capital markets. Aaron, welcome back to the show.
Thanks, Oliver.
Appreciate that. Let's start, I guess, with how we dodged the big risk folks were saying was commercial real estate back in the spring. Everyone was convinced that's what was going to be the switch that flipped us into recession. How come it didn't?
Well, we figured a way out of things in some ways where it's really the expectation was that interest rates were going to fall. At what pace and when was still an open-ended question. And the most recent discussion from the Fed indicating some rate cuts happening next year has really helped essentially bail out the market. So what we've done in a lot of cases, we had maturing debt, we were able to extend it, loans were able to be paid down in some instances, or we just said, let's add another year. Let's figure this thing out in 2024, 2025, et cetera. Kick the can, essentially.
Oh boy,
and that's
not reassuring.
Unfortunately, that's what we've had to do in some of these cases. At the end of the day, interest rates rose quite quickly. It took a lot of real estate investors off guard, particularly those that have floating rate debt, and it's been a challenge to recapitalize all those deals. So we're ultimately sort of resetting the market, and 2024 looks to be a much more liquid year than 2023 from an overall real estate investment standpoint.
Obviously, if we get a bunch of rate cuts, it's going to help. But given that we discussed that ad nauseum here, with the very macroeconomic focus, I'm curious more from like a fundamental credit perspective. What matters more in your analysis, rates or the techification post-COVID of working from home? Like when it comes to commercial real estate and I guess all forms of real estate, because now that's why we've had such demand for new homes too, right? Because they're kind of home offices. What drives the bus?
So the cost of capital is what drives the bus,
Really?
and the availability of capital. Yes,
Okay.
if you can't get a loan, we're not transacting.
So we don't get cuts, we might be in trouble next year still.
Well, I mean, if we don't get cuts, it's still saying that we're at a peak interest rate environment allows you to plan. That's been the biggest challenge. If you look at 10-year Treasury this year, it's been a yo-yo, right? It's been up and down. It's been up and down. So if I'm pricing debt as a lender or as a borrower, it's been really challenging over the last 12 to 18 months, 24 months. So if we're here at a rate peak and we expect things to get better, that'll get some deals off the sidelines.
Okay,
but even
so
with the
even if
challenges
we
that
don't have a big reversal, just because that's an important point, even if we don't have a big reversal and rates lower, it seems like you're arguing that if we just kind of plateaued and took a break here, it'll help people kind of figure out how to assess the situation better and maybe calm volatility.
Yes. Correct. Uncertainty, nobody loves uncertainty. Real estate, other industries as well. So with that expectation of peak rates, it'll get groups off the sidelines because the expectation is that there will be lower rates in the future. So if I borrow today, I could refinance in the future. I will get transactions off the sidelines with some sellers who have been waiting on the sidelines saying, I'm going to wait until I get more clarity. They'll come off the sidelines and that will open up opportunities for new investment and potentially reset basis, which is one of the things that we're really looking for in 2024, particularly in the office side, in core markets like Boston, New York, San Francisco, Washington, D.C., et cetera, where some of the office buildings that are starting to trade are at such a low basis that it seems to be a generational opportunity, really, from an investment standpoint.
Who goes in? Mathematically, I'm sure that's the way it adds up. Like, I'm sure your scan is going to pull back like the lowest valuations, ever in some of this stuff, especially with the economic backdrop, right? Like, if you've got a model of commercial real estate that looks at unemployment, that looks at jobless claims, that looks at income, and then looks at the valuation of the real estate, it's probably going buy. But who actually moves in there? Like this building here, they're shutting down the grocery store across the street. They already shut down the restaurant downstairs. And the grocery store is literally, that was a week we found out that one's closing down. Schwab's consolidating, that's no secret. There is a big opening and a lot of space. Who moves in here?
Well, we're going to continue to see economic growth here in the U.S. economy. Now, I'm not going to tell you it's going to be XYZ company necessarily, but if you look at long-term growth in the U.S., it's up and to the right. So we are going to see new ventures created. We're going to see evolution of companies. And really it starts to come down to which buildings you want to be in. Commodity standard, nothing special building, those are the ones facing the challenges. That's where the vacancy is. That's where the value degradation is taking place. And you're seeing those rock bottom sale prices. Your true Class A buildings with amenities, the hotelification, if you will, where we're offering this concierge type of service and experience and drawing people in. We want the office to be a magnet as opposed to a mandate. And those groups that are able to put that together, and the companies that can work together to ultimately create that environment, are the ones that are winning out and stand to really benefit over the long term.
I like that. Magnet over mandate. That's a pretty good little buzz phrase to describe what needs to happen to prevent these from kind of dwindling under the work from home environment. Aaron, really good conversation. Thank you very much. Let's keep talking about it next year.
Thank you.
Absolutely. Aaron Jodka from Colliers. Okay.